Good morning, good afternoon, good evening, everyone, and thank you for tuning in again to the STA. I am Jeff Boccaccio. I am one of the STA board members, and one of my responsibilities is organizing these monthly events, which is always a joy, but especially so when I get to chat with some industry legends like we have with tonight's speaker. Now, before I introduce him, I know we have some guests coming along today. So if you're new to the Society of Technical Analysts, the STA, we are a not-for-profit organization dedicated to promoting the understanding of technical analysis and its role within behavioral finance. Excuse me. Part of how we accomplish all of that is through education. In fact, a big way that we accomplish that is through our educational programs, where we've got both live instructor-led courses, and we also have sort of at your own pace home study courses as well, both of which are geared towards preparation for exams that we run for industry recognized certifications in technical analysis. So if you're interested in that sort of thing, we'd really encourage you to check out the STA's website. It's technicalanalysts.com. As a heads up, once you pass these exams, you're considered a full member of the STA. But we also have an associate member tier, which anybody can join and get all the benefits of these monthly events. They're Zoom-based or in person. We've got videos of all the past events. We've got a biannual STA journal. We've got an extensive library at the Barbican Library and also electronically available. So there's a whole lot of stuff that you get for really not much money. There's also a student tier. So any students tuning in today, I know there's some of you that, because Simon's been doing the rounds, there's a student tier that's available for just £25 a year. So that's a year, not per month, per year. Yeah. Okay, so on to the main event. Tonight, we are continuing the STA's global tour back in the United States, and with somebody who really needs no introduction, but I'm going to give it a try. It is, of course, no other than Bob Prechter. Robert, but I checked earlier, Bob is okay. Bob is probably best known for his work on Elliott Wave theory, and he's the CEO of Elliott Wave International, an independent market analysis firm. He's written numerous books, I think something along the lines of 20, with the seminal work really being the Elliott Wave principle back in 1978, as well as various papers that have been published in prestigious journals. He's actually presented to us here in person in London before at IFTA 2014. If you remember that, Bob, that was coming up on, well, almost 10 years ago now, right?
Yeah, great time.
Yeah, and you know what? We actually made that video available after the event, quite a few years after the event, and it is still now it's like one of our most popular videos going. So it's still really interesting to see the amount of interest in the subject. The title, I wrote it here in my notes, was Socioeconomic Theory, an Alternative to EMH and a Foundation for Technical Analysis.
Oh yeah. So that was a good time. I think I had been there once before as well.
Well,
so
I've got a little bit of breaking news. This is sort of like hot off the presses because we just came out of our board meeting, and Eddie, the STA chairman, just said that we have been, it's finalized now that London in IFTA 2026 is going to happen. We've been talking about it for a while, but we've actually got the go ahead now. So, Bob, maybe we could convince you to come back over in 2026.
You know, I'm virtually retired from doing these things, but I love London, so who knows? Let's talk a little bit later.
We'll see if we can twist your arm. Okay. Now, I feel like I need to hand over to Bob now. He's ready to go. Now, when we know Bob, many people know of you from Elliott Wave Theory, of course, but you are also the founder of the Socioeconomics Institute, and I believe you'll be speaking to us more from a socioeconomics point of view this evening. Am I right on that, Bob? No?
Nope.
Oh, okay, great. Cool. Well, I'm going to be surprised too.
It's going to be pure technical analysis, and it's virtually no Elliott waves either.
Okay.
I think there's something really important going on, has been for a few years, and that's where I'm going to zero in on.
Excellent. Well, let me stop talking and hand over to you, and let's get going. Thank you very much. Everybody, Bob Prechter.
My title here is An Era of Exceptional Optimism, and I'm going to show you what I mean by exceptional. back in December of 2021, I wrote an issue of the Elliott Wave Theorist titled A Stock Market Top for the Ages. So this went out in December 2021, which, as luck would have it, just happened to be between the broad market high in November 2021 and the blue chip index highs in January 2022. And I'd like to show you the pictures that we were looking at back then. And what we were doing was reviewing all of the sentiment indicators that we had been showing throughout the year of 2021. And I'm going to show you why they were exceptional. Here's an example. It goes back over 100 years. It's a sort of a combination sentiment indicator that shows the valuation of stocks with several components. That is, stock prices relative to GDP, relative to corporate sales, relative to corporate earnings, and relative to corporate book value. And you can see we had names for each of the prior manias. We were calling this one the everything peak for reasons that will become clear a little bit later on. But it made new all-time highs in 2021, this composite indicator. You can see a little close-up of single readings here. The valuation back then was 3 times 12-month corporate sales. You can see that way back in 2000 at the top, in 2007 at the top on this chart on the left, you had numbers around 1.7 and 2.3, the average 2.0. And now in 2021, we were seeing readings beyond 3.0. We're setting records. On the right, you can see that the Wilshire 5000 index as a percentage of quarterly GDP in the United States was at a new all-time high by, again, a lot. We had record margin debt. Now, record margin debt doesn't in itself mean the market has to top out, but you can see that the last few times the market did top out, we were at a record of margin debt, and we were at that again in 2021. We had record low investment in money market funds at that time. It was down to 2% among retail investors. They did not want cash. They thought cash was trash. The only thing they wanted in their portfolio, besides a house usually, was stocks. We had an all-time record low in the cash being held at mutual funds. That's the chart in the middle there. And again, that was around 2% as well. They had never been that low on cash before. The implication is obvious. They thought stocks couldn't go anywhere but up. Why in the world would you want to save some cash and buy them at lower prices when there wasn't any possibility of them going down? That's why this is a sentiment indicator. They were fully invested and proud of it. And at the bottom, you can see that the total RIDEX money market assets were also making a record. Speaking of RIDEX, now, even though this is in the middle of our chart array, this is my all-time favorite chart, and I talk about it whenever I'm given the chance. Look at the center chart and the bottom chart, and you'll see the ratio plotted of the amount of money that investors at RIDEX have put into bullish funds versus bearish funds. And if you go back to 2000 and 2007, you can see that previous ratios are around 2 to 1 or maybe 5 to 1 at brief extremes, meaning when people were more or less bullish, they would own the long funds 2 to 1 relative to the short funds, or for a brief time in 2000, maybe 4 or 5 to 1. Well, it was going up in 2018, 2019, 2020, and 2021. As you can see here, the bull-bear ratio at RIDEX, the amount of money in the bull funds versus bear, went up to 62 times. There was 62 times as much money in the long funds as the short funds. But look at the lower chart, and you can see that the people who were really gambling on the leveraged side of things, on the long side, had 82 times as much money as they had on the short side. That is confidence. That is bullishness beyond belief. I don't think we've seen those numbers since. Okay, now what about large traders? Most people think large traders are pretty smart, but actually, if you follow the commitment of traders reports, you'll eventually learn that the large traders are not that smart. They tend to be trend followers. And in 2021, they were their buy to open call purchases as a percent of the total was the largest ever. Well, guess what? Same thing was true of small traders. Everybody was on board this ship, and they were making a record as well. The amount of money that people were paying for call premiums, set a record. And look at how much of a record it was. Look at the two arrows to the bottom left. Those are down around 7. And then way up here at 44 billion, they were just pouring money into calls and being happy to pay up for premiums. Okay, this is the total amount of assets in the largest leveraged long index funds. These are leveraged bets. And as you can see, the amount of money dedicated to these was the highest ever, again, by a long shot. We had record trading volume in penny stocks, again, dwarfing what we had seen before. We had record dollar volume of IPOs. We had a record number of total IPOs plus secondary offerings. But that's not the most fun thing regarding these IPOs. We found a ratio of negative versus positive net income for the companies involved in IPOs. And it turns out that 12 times as many IPOs that people were gobbling up as fast as they could were losing money relative to the number that were making money. That's an incredible statistic. But it's not the most incredible statistic. This is a chart, and we were thrilled to see that Goldman Sachs was keeping an index of non-profitable tech companies and what their share prices were doing. And as you can see, after the low in March 2020, they were absolutely zooming and eventually got up to about 5 times the value of what they were just the previous year. It's an amazing thing that people were buying stocks with no regard. I might have said virtually no regard, but as you can see, there's no regard whatsoever for whether the companies were any good. And then we can go one step even further than that, because we also had a record valuation for firms earning too little to pay debt interest. Now, how is that even possible? Well, what they're doing, of course, is they're borrowing more money to pay the debts, to pay the interest on the debt. And people were perfectly happy to own them to a record valuation. That is amazing optimism. There were record deals, of course, for raising capital for no stated purpose. These were SPACs, special purpose acquisition companies, and the IPOs on them was off the chart. We had to extend this one to make the chart. And so that is, again, I said earlier, without regard to what the companies were doing, this is without even caring what the companies were doing. They wanted to own them no matter what. They believed in magic, the man behind the curtain. We had record NASDAQ to S&P 500 volume, even higher than the famed .com era, which topped way back in 2000. Back then it was about 1.4, and now it was about 2.5. There was a record percent of money managers that admitted in polls that they were taking higher than normal risks. It was up to almost 20%, the highest it had ever been. This is the average money manager now. And this is one of my favorites as well. They actually keep a record of the opinions of the most bearish stock managers. I'm not sure what the cutoff is. Maybe it's a percentage of all managers, but the most bearish ones, when they interview them and poll them, they ask them, well, how bearish are you? And here's a chart of how bearish they've been. And you can see the dark lines at the bottom of the chart are mostly below 0. That means the bearish managers were usually short. And you can see by where the cutoffs are that they were often 100% short, and on rare occasions, 200% short. Well, in 2021, they couldn't stand it anymore, and even the most bearish money managers were long to the tune of 75%. That was only the second or third time on this chart they had gotten to that level. Households' equity allocation as a percentage of total assets also is hitting a record. Now, this is amazing because most households' assets are homes, but they had stock worth more than their homes at this time, and a larger percentage of their net worth was in stocks. And homes were not in a bear market either. They were going up as well. So that just shows you how optimistic people were in terms of we must own stocks as part of our portfolio here at home. We had record foreign investment. And one of the first things I learned when I went to work for Bob Farrell in New York City was that foreigners tend to come in late in bull markets. And we had seen that way back in 2000, 99, 2000. We saw it again at the 2007 high. They leaped in right at the top, and they were pouring in again in 2021. Again, another top indicator at the time, or at least we thought so. We also look at some sort of esoteric indicators. This is Google News searches on fear of missing out combined with stock market. And they were surging as well. People were searching for those two things very often and very afraid that they'd be missing out on the bull market if they didn't read up on it and go figure out how they could buy stocks. And here's a kind of a fun one. For many, many years, I've kept a two-part ratio so you can plot it on X and Y axes. And on the Y-axis here, you can see we have the S&P Industrials price to book value ratio. And on the X-axis at the bottom, we have the S&P 500 annualized dividend yield. Well, I'm showing you this chart to show you what was considered normal for 50 years or 60 years between 1927 and 1987. So you can see there's a box around the area where the year-end valuation tended to be in that zone. Well, what happened after 1987? Now get a good look at this box and see if you can find it on the next chart. Give you a hint, it's way down there at the bottom. That was the normal valuation for most of the 20th century. And since then, the year-end valuations on both of these measures has gone higher and higher and higher. And at year-end 2021, if you look at the upper right corner, you can see where the valuation ended there. 7 times book value and just over 1% dividend yield. That had never happened before. And look how far from normal that is. We like to call this our Pluto chart because it looks like you're out on Pluto here. Look at what we have down on the bottom left corner. That's where valuations were in June of 1932. When things get stretched too far on one side, they tend to get stretched too far on the other. And I think there's going to be a reckoning on this ratio, or these two ratios. All right, I think we also had some bull markets in nothing. And let me explain what I mean by that. I've plotted the Dow Jones Industrial Average here on top, and underneath it is a chart of Bitcoin. Now, I was a huge Bitcoin fan in the early days, and the reason I was is because my son, who just for reasons unexplained is named Elliott Prechter, he came to me, he went to MIT, and he was interested in all kinds of financial things and numbers, and he said, you know, there's a new invention called Bitcoin. And he explained it to me, and I said, that's fantastic, because it would be a coin that was not manipulated by a central bank. That's a wonderful thing. It's a coin that once they had created them all could only deflate. It couldn't be inflated out of existence like fiat currency. So I said, this is really terrific. So he wrote it up and I edited it. We put it in the Elliott Wave Theorist. And we said, well, this new thing, you probably never heard of it. It's trading at only 6 cents. And it's hard to find people who can sell them to you, but you have to seek them out if you want to own them. And we predicted a big future for this. But I have to tell you, we had no idea how far this thing would go. It started at a penny and ended up at $70,000 a coin. That's 7 million times gain. Forget the tulip mania. That was nothing. That was like a 60 times gain. This was 70 million times. Well, the strange thing was that along the way during this bull market, it became clear that the blockchain Bitcoin was using could not handle worldwide trade. And we thought, okay, well, this is probably some sort of kiss of death, but it wasn't. And which basically proves the essence of socioeconomic theory of finance is that financial markets are non-rational. And this certainly was, as you know, the bulls had the bit in their mouth and they were plowing forward throughout the period. They didn't care what news was coming out. Well, look at the amazing connection between the Bitcoin bull market and primary wave 5 in the Dow Industrial Average. That's the circle 5, which you can see at the top. It started in 2009 at a penny and went all the way up until guess when? The exact month of the high in the Dow Industrial Average and the S&P 500 and the New York Composite Index, which was January 2022. That was the month that Bitcoin topped out. I think it was simply a fellow traveler along the bull market. It was propelled by a wave of social optimism, and it just happened to capture more than one market, and one of them was Bitcoin. And that was sort of a fifth wave phenomenon, amazing thing. So if stocks have started a bear market, which is my opinion, but could be wrong, if it has, then Bitcoin is probably in one as well. Now, this was truly a bull market in nothing. NFTs, they started coming to the fore, not in 2009 at the bottom of the primary bear market, but only in 2020 and 2021. This is after intermediate wave 4 of primary 5. And even during waves 1 and 2, they hardly budged. Suddenly, when we got into the third wave in the Dow, people got incredibly interested in these NFTs, non-fungible tokens. Well, what are non-fungible tokens? They're just zeros and ones arranged usually with color on a palette, and then most of them look like cartoons. And of course, you could take out your cell phone and take a snapshot of it and be just as happy. But people were paying up to $1 million for these things as we got into minor wave 3, 4, and 5. And if you look at the bottom graph, this is the worldwide Google search interest on the term NFT. The exact peak was January 16, 2022, only 3 days after the all-time high in the New York Composite Index, which you can see there at the top, listed at January 13th. And by the way, the 16th was a Sunday, so it's really only one trading day later. This was another almost perfectly timed bull market. This was really a bull market in nothing. They've since crashed to virtually zero. And again, it was a product of a wave of social mood. In this case, the fifth of the fifth wave of the bull market. So I think, again, optimism was just ridiculous. We talked about people buying stocks with no care for what they were buying. They were buying other things as well for absolutely no rational care for what they truly represented in terms of value. Okay, now we face the question, and this is why I wanted to present on sentiment today. Has anything changed? You would think that having come off the highs, and with broad market indexes being weaker than the blue chips and so on, that some people might have become a little more cautious. But we can still see some indicators that have actually hit records of optimism. This is one that was introduced to me by my friend Peter Eliades, and he was following this ratio. Well, why would we follow this ratio? It's the ratio of the NASDAQ 100 to the Dow Jones Utility Average. And what that is a ratio of the most speculative major index, stock index, versus the price of the least speculative and most conservative stock index, the utility average. Utilities are regulated industries. They pay dividends. You know, if you're really cautious, that's what you want to own. So we were curious as to how much more people preferred and were pricing the speculative stocks versus the conservative stocks. And as you can see back in 2000, where we have an arrow there, the ratio hit, I think, 16 and change. And after that came a big bear market where the ratio dropped 82% as the S&P lost 57%. Well, in 2021, it hit a new all-time high around 18. And that is an amazing thing as well. Took out all the previous highs, just like all those charts we showed you from 2021. But in the last couple of months, it has gone to another new all-time high, just shy of 19. That tells me that the speculative mindset has not only not died, but it's just as strong as it's been any time in the last 3 years. That's an amazing thing. I showed this a few weeks ago in the Elliott Wave Theorist, just to kind of give you some perspective on some extreme indicators. You can see in the upper right-hand corner the VIX. Now, this is billed as a measure of expected market volatility. It's not really that at all. It's simply a measure of current complacency versus fear. And way back in February of 2020, you can see over there on the left side of the chart, VIX hit a low of 13.38. And here just a few weeks ago, it was as low as 12.68. That meant there was more complacency then, recently, than there was back at the top in early 2020, just before the stock market fell the fastest rate for that amount it had ever fallen before. Now, the DSI is a daily sentiment indicator. You can find his work at trade-futures.com. And right near the high for the NASDAQ in 2021, the DSI reading got as high as 93. How it's constructed is a little bit proprietary, but it suggests the idea that 93% of participants are bullish. And then here in the summer of 2023, we got another reading at 93, despite the fact the NASDAQ was lower than it was at the previous time. So we had just as much optimism as we had at the all-time high. There was a peak level of call buying this summer as well. You know, the S&P peaked on July 27th, so far anyway, this year. The Dow, I think, was August the 1st. Well, if you look at the bottom graph, you can see that the last time we had been at that extreme of a put-call ratio was at the top in early January 2022. And there in July, we met it again. So optimism was back by this measure to just the same amount that it was at the all-time high. And we were getting reports like this one. A new ETF came out, and it was looking to tap the hot market for zero-day options. So what you've got here is a derivative of derivatives, an exchange-traded fund that wants to participate in the hot market for short-dated equity options, a risky strategy that has enthralled markets over the last year. And of course, enthralled is a very good word when we're looking at psychology. That's exactly what was going on. And it explains short-dated options contracts with a day or less to expiry have grown popular with investors over the past year, often making up as much as half the daily trading volume in the options on major ETFs and indexes. So the speculative mindset among the public is as crazy and as heated as it's been throughout the last few years. We had a really fascinating rally in a stock for a company called VinFast. It ran up 504% and then crashed at its very peak, as you can see by this underlined text. An unprofitable electric vehicle maker was at the zenith of a 4-week trading frenzy and had a market value greater than McDonald's and 4 times that of General Motors. So people are willing to buy things without much concern for underlying value. And of course, they got burned, as they certainly should have. And we're seeing covers like this past summer, feeling bullish. If you go on YouTube, you'll see that people are promising you millions, billions, and trillions of value in various stocks. So that you don't see that in 1974, and you don't see it in early 1988 or even in early 2009, but they're everywhere today. Some of you have, this is by popular request. Many people say, if you're going to speak, please talk about the hemline indicator. So here it is. This is what we're seeing on the runways in recent months. They've started calling it, hot pants are back. And then they realized, oh, this is the hot pants trend or look. It is the no pants look. It's not only on the runways. You can also see it in among celebrities, who are going out clubbing and things like that. I was just down in New Orleans and there was a concert that people were going into, young people were going into, and I can tell you this short skirt phenomenon is definitely back, just like it was in 1967 and 1999. So here we are again, and there's a reason why this indicator works, because in waves of social mood, people, when mood gets increasingly positive, people do a lot of different things. They want to see certain types of movies, they bid up stocks, and they wear frisky clothes. And so that's why these things coincide. And it's hard to get friskier than this look right here. Now, I've been asking myself, why why is this reprise happening? You know, what is the reason why people can't seem to let go of this optimistic feeling, except for the brief period late last fall? Well, I just put some cycles together because the 4-year cycle has been pretty reliable for a long, long time. And that's at the bottom of this chart, showing that the 4-year cycle bottomed in 2016, 2020, and is due to bottom again in 2024. Now, I don't bet my life on cycles because every now and then they just plain disappear. And you shouldn't bet your life on this one either. But I have noticed that we seem to have been making peaks of optimism every 2 years. There was January 2018, that was a peak in optimism, February 2020, and again, November 2021 to January 2022. And 2 years after that should be between November of this year, in other words, basically now, and January of 2024. That's when the 2-year cycle peaks again in terms of optimism. Now, a peak in optimism doesn't necessarily mean a peak in prices. We can be losing ground while people are still very optimistic. It just says that at some point, that psychology is likely to change somewhere between now and January 2024. And I am going to end with just one chart that does show an Elliott wave, because the blue chip averages, especially the NASDAQ indexes and the S&P, to a much lesser extent, the Dow Jones Industrial Average, are difficult to count in Elliott wave terms since the high. I think the Dow has done an expanding leading diagonal, but we can't be 100% sure about it because it's rather a rare formation. What has been clear is the impulses in the broader market indexes. Now, I'm not going to show the one from the high, but it's just as good as this one in the Russell 2000 index. That is from November 2021 to October 2022. But this is just showing you the wave from last July. And if any of you are Elliott Wave aficionados, you'll recognize a very beautiful impulse to the downside. Minor wave 1 down, 2 up, 3 down, 4 up, and 5 down. And this was updated to just about an hour and a half ago. We've had a big update today. And of course, people are saying a new bull market is launching. And, you know, it might be. I could be wrong about this, but I'm tentatively identifying this wave as wave C in the broad market. What it means for the blue chip indexes, we'll have to see. But I think as long as the Russell and the other broad market indexes continue to trace out really clear patterns, we're going to go with them. Okay, now, just briefly, some people might be interested. Well, if this is true, what are good places to invest right now? One of the most, well, probably the most, the investment that I have most suggested in the last few years has been floating rate notes. These are 2-year issuances that fluctuate constantly with the yield on U.S. Treasury bills. So you don't have to roll them over every 30 days or 90 days. You can own this for 2 years and still get the T-bill yield and get more and more as it goes up and up, or less if it goes down. Whereas people who own the bonds, they're losing value, of course, because the capital value of the bond keeps falling, but not in these instruments, Treasury bills and the floating rate notes. So I think we have a bull market in interest rates that you can see on the left chart. We also, I think, are probably in a bull market in the US dollar. You can see that when T-bill rates started to go up, the dollar started to go up, but also it went up while the stocks were going down. And when stocks were going down and bottomed late last year, the dollar was at a very high level. Well, people fell in love with stocks again quickly and started buying stocks. And of course, they don't want cash and they didn't want the dollar. So they sold that so they could afford to buy stocks. And in the summer, this summer, it seems that the dollar has bottomed along with the top in the stock indexes. So if we're right, that sentiment is overblown and way too optimistic, somewhere along the line, a bear market is going to really take over. And I think that'll mean lower stock prices and along with it, a higher dollar. So if you are in an instrument that is yielding the same as the Treasury bill and the dollar itself is going up in value, that's a double whammy and a very good place to be. So that's where we've been parked for quite a long time. And I don't see any reason right now to get out of these and to buy stocks yet. That's going to be someday in the future. Just, interest rates could be peaking out. But if you look at this long-term chart, you can see the last time they bottomed at very low levels, which was the 1930s and early 40s, they turned up and went up a long way. And they bottomed again in recent years, and they've turned back up. So at least we can say there's quite a lot of room for rates to continue higher if that's what they want to do. So I think it's too early to be buying long-term bonds as well. And certainly not junk bonds, because they still yield very little in addition to treasuries, which tells us yet again that optimism is absolutely inbred in people's minds right now. I'm going to show you just one chart of gold. We could show a lot of perspectives here, but I'm just going to show the last few years. Gold's been swinging wildly, but going sideways net. It's still within this sideways trading range. But there are a couple interesting things here. We think it probably ended a correction in 2022. It had a first wave up and a second wave down that subdivides pretty clearly into an ABC. So we think we've had minor wave 1 up and minor wave 2 down, which suggests we need minor 3 up, 4 down, and 5 up to complete a bull leg. That suggests all-time highs coming in gold. I'm a little less confident about this than I am with the idea that stocks are eventually going to go way down and be in a bear market, but this is what we see at the moment. If you look at the bottom graph, you'll see that large speculators are trend followers, as we mentioned earlier. They were afraid of gold at the bottom, of course. They got really excited at the recent high, and now they backed off again, and they're not heavily owned in terms of the precious metals. So that tells us there's plenty of buying power available. So if gold goes up, eventually the large speculators will be part of the reason it's going up. And once they get overdone on the upside, we'll come back and talk about it. But right now there seems to be a lot of room for them to get further long. And the last thing I'd like to bring to your attention in terms of where you might think about investing, this is a long-term chart of stock prices relative to commodity prices. It's the Dow Jones Industrial Average divided by the CRB index of commodities going back more than 100 years. And you can see that back in 1920, this ratio was below 1. In 2020, exactly 100 years later at the year end, these are year-end closing values, it was just shy of 200. It was a 233 times multiple from low to high when you measure it from the actual lows and highs. That is an amazing change. It's not just that stocks have gone up, it's that they've gone up even relative to things, to this absurd multiple of 200 times, more than 200 times where they started. Back then in the early teens and up to 1920, even through the late 40s, people valued things, and they valued them a lot relative to share prices. Now people don't put stock in things at all. They don't think things are worth much. They want stocks. Well, we have come off a little from this high. This is sort of an update with a little more detail of just the last few decades. So I think the top is in there in 2020, and mostly the decline in the ratio is due to the fact that commodities had a run up. So I think there's going to be I think we've already started a fundamental shift in the value of things versus the value of stock shares. And I think this shift is going to last many years, decades for sure, as things become a little harder to get hold of and stock shares become less and less desired. I'll just end with this screenshot because, we figured we know people, other technicians don't subscribe to anything, so that's fine. But you do read books. So I said, well, look, why don't we just do a discount for STA people? So if you go to this page, you'll find, some of the popular books, maybe some you haven't read. I think my gnomes decided they wanted to put half off or something like that. So come visit us there. And that about does it.
Bob, thanks so much. That was super fascinating and a great run through with quite a lot of charts for all of us who love to see charts.
You gotta look at.
Yeah, I mean that's there was a lot there, and I love that you did manage to squeeze in just a little bit of socioeconomics with the hemline index. I was looking at that recently when I was just investigating your website really on socioeconomics, and the hemline index being basically, linked in with stocks. However high your hemline is the optimism and probably highs in the stock markets, and then the opposite is like literally the full on gown. A super fascinating
In
thing.
1974, there was a style called the maxi skirt.
Okay. Okay, didn't know that one. Out of interest, I wonder, first of all, I should say, if people have questions, please feel free to drop them in. It's easier for us if you can do it in the Q&A box, but also you can drop it in the chat if you need to. The first thing that kind of strikes me about many of these charts was really, especially the front loading of your presentation, was a lot about 2021. Right? So 2021, we were just breaking all of these records and shattering all of these records. What do you think it was about 2021 that made it I don't know, I'm gonna guess it was sort of the perfect storm for all of that. But is there anything in particular? I've got a few ideas, but from your point of view, how do you see that?
Yeah, in fact, I was showing a chart in January that year showing that a beautiful Fibonacci progression of years between turning points would end in 2021. And it goes back 233 years to the founding of the Republic, and the 1932 low and 1966 high, and so on. All of them were connected by a Fibonacci number of years, going down the spiral to smaller and smaller distances. And they all culminated in 2021. There's actually only one that culminated in 2022 out of the whole array, and I didn't know what to do with it. But the market did, because it topped almost all the stock indexes in 2021, the broad ones, and it just had the blue chips hold up until the second trading day of 2022. So it's a beautiful array. I also have a small book called Last Call, where I put all of the things from 2021 that we felt were indicative of the end of a grand super cycle. It was a term Elliott used, which was a 233-year advance. And so that's one reason why I'm hesitant, as some people have lately been doing, calling for new highs. I think 2021 was a very important year for all that. So however it wants to fool me and us, I'm sure it's got tricks up its sleeve, but I think 2021 was truly a watershed year.
I mean, there was so much going on, right? We just come out of COVID, right? People have been in lockdown. People were bored in lockdown. They were being given money a lot of the times by the government, at least people in the States. And so you had all of the meme stocks. And so I guess, in a way, it almost, so many things together. And then it also kind of almost as entertainment, I think some people were just getting involved in these markets when they probably weren't before, and possibly aren't anymore.
Yeah, trading from their parents, from the bedroom in the basement of their parents' house on their iPhones.
Right.
Yeah, a lot of that was going on, but we never look at those things as causal. We see them all as results. And if you look at the Elliott Wave formation from January 2018 to March 2020, you'll see a beautiful expanding triangle. And it's the final wave in a bear market where the fundamentals just leap out at you. We didn't predict that there would be a pandemic, but in the past, pandemics have occurred at the tail end of bear markets as well. And suddenly this one emerged throughout the collapse that occurred in wave E of that expanding triangle. And then it turned around, as you know, I think it was the third week of March in 2020. Now that was very early in the pandemic. Many people were still getting sick and dying, but the market was done. The wave of mood was over, and it leapt to the upside and went to new highs because the triangle was wave 4. Wave 4's triangles always occur in the wave 4 position when you have an impulse. So we think that was wave 4, and we think wave 5 topped out in 2021, and that in itself had implications. For example, the economy holding up. Economy lags stock prices, and it's been holding and holding and holding, and it will not go into contraction until the stock market is clearly in a bear period. So we think most of these news events are lagging. except for the news of what women are wearing on the runway.
Right, right. We've had a couple questions coming through that I'll try to just integrate in here. And some of them are on topic with what you've been talking about. One of them coming in from Dan was, is the bear market finished or over? Which I guess presumes that there was a bear market or we were in one. And I don't know if we ever really finished the bull market. How are you seeing that yourself?
Well, the stock market, according to R.N. Elliott, is fractal. So you can call almost any move a bull market or a bear market as long as it follows the right form under the wave principle. So you could call the decline from late 2021 into October last year as a bear market, but I think it's only one wave within a larger bear market. And we had a recovery, clear ABC rally, so that's counter trend into late July, early August of this year. But right or wrong, we're counting those as wave 1 down and 2 up, not even A and B. So I think those are 1 and 2 of a 5-wave decline that itself will be wave A. So I think the bear market is going to be huge. And I think we'll see sentiment that ultimately balances on the other side of the scale, extremities of optimism that we saw and still are seeing here in 2023.
That sentiment, it was an interesting thing thinking about socioeconomics and, that the idea that how people feel influences how they act. And
Exactly.
Thinking about it from, I guess where I'm coming from on this is, what does it take to change that sentiment or to change that mood, right? Because
most people think that events shape people's mood, and the socioeconomic theory is the opposite. People's moods, aggregate shared moods, are endogenously regulated. It has nothing to do with the outside news, and how they feel prompts them to act in certain ways. So when markets are going up, it's a reflection of that social mood. They'll buy stocks and do many other things as well. They'll get more productive in their businesses. And so you see the economy expand with lag, because it takes time to get your business going and so forth. I think we've been able to tie in some 40 different social phenomena to waves of social mood, but nothing comes in to change it. These are natural waves. It's like, what could change a tree from branching? It's going to branch no matter what. But what we can't do very well is predict how long a wave will last, because the key is form, not fixed time durations, not points or anything like that. It's all structured as form, and therefore time and price relationships, not absolutes. So the bear market will be over when the form is over, and when the form is over, society will have gone from a point of extreme optimism to a point of extreme pessimism, or we'll have taken an Elliott Wave path to get there.
Could you talk just a little bit more about what you mean by form?
Yeah, well, the whole wave principle was a description of forms that R.N. Elliott came out with in 1938. He embellished it slightly in 1946. And it's a structure of 5 waves in the direction of the larger trend, and 3 waves or multiples of 3 waves in moves that go against the trend and are only partial retracements. And that was his fundamental observation.
Gotcha. Thank you. Question even from Niels. What do you think about the strong bullish moves in the equity markets, NQ, ES, DAX, etc., that have happened in the last week and seem to still be going on? You mentioned this a little bit with your chart on Russell earlier, and since I guess it was really since the beginning of November, by my reckoning, right? We really kind of launched off in equities after sort of a decline over most of October, and now that's kind of popped back up. So I guess Niels is just after what your thinking is on this.
Do you remember the chart I showed of the Russell 2000? Beautiful 5 waves down, and we needed to rebound. So we're rebounding. This is why I keep saying form is in charge. When 5 waves are done on the downside, you're going to get a counter trend bounce. If I'm wrong, it'll keep going all the way to new highs, and we'll have to look back and say, well, what was that 5 waves? Was that some sort of C wave, on the downside, and we're really in another giant bull market? But so far, right or wrong, we're counting it as a normal 5 down, and we're in a normal ABC up, or it could turn into a double 3. Sometimes you get a double zigzag as a correction, which means it's going to drag on even longer. Possibly, well, I don't even want to guess that, because again, we're going to be watching form. But I have really nothing to say about, why did it happen other than that? I really think that is the reason. Markets move in Elliott waves.
Gotcha. Do you personally, sometimes it comes down to, we can recognize form, we can recognize charts sort of after the fact, I mean, as it happens, which is kind of separate to prediction of those turning points, or even just trying to get the timings right on that. Do you yourself use, say, Elliott Wave theory in order to time, or do you use it more as a mechanism for reading where we are in the bigger picture?
I really think they're sort of the same thing. Anytime you put labels on a chart, it implies what's coming. You really can't avoid that. So people who label Elliott waves in a chart are always implying, what the future waves are going to be. So when we look at that Russell chart, at least with our current labels on it, you see 5 down, ABC up. That tells you we think the larger trend is down. That's the direction of the 5 wave movements, and we're counting rallies as 3 waves. And I just want to throw in, because of kind of the implication of one of the earlier questions, bear market rallies are typically violently sharp.
Yeah.
And if you're a bear, it scares the hell out of you. And if you're bullish, you're like, here we go, it's a new bull market. And then you look back and, oh my gosh, I guess we're making new lows again. That's what happened in 2007 to 2009. There were some violently sharp rallies during that period, but ultimately it brought the S&P down by more than half. So we actually think that these kind of violent moves are, fit the outlook we have. Now, sometimes you can get kickoffs to great bull markets that are like this, but we don't think that's the position of the market. If people were really pessimistic and we completed a bear market and we could count 535 on the downside, and then we'd be saying, look for a breadth thrust on the upside to kick off the bull market. But we're nowhere near that. Everything we're looking at is telling us we're still seeing the kind of psychology you get at major tops.
Gotcha. Yeah, you've made a good argument for that today, I think. How about if we go back to commodities? There's been a question about commodities specifically. Are there specific commodities that you are bullish on, like oil, gold, metals?
Not really. The only comment I might make is I think housing has topped out. It hasn't really started falling very hard yet, but we're getting some preliminary hints that the housing market is weakening somewhat. The rents in Atlanta just got reported today as being down, and suddenly they've got some space that they can't fill. We already know what's happening to commercial real estate. I mean, something like a third of Atlanta commercial real estate is empty. The office buildings are empty. It's acres and acres of available office space. So it started with the commercial, and I think it's slowly going to be spreading into residential, probably has already started. And all of that is due to over leverage. Most of it is paid for with debt. That's how they got to those prices in the first place, because people borrowed to push up the prices so they could own this stuff. And that's what happens when people get too optimistic. But to get around to your question, I wouldn't want to be long lumber.
Okay, gotcha. Yeah, lumber had a great run, didn't it? Not too long ago, but yeah, they got a little bit overblown. I remember just the price of I was rebuilding a dock. We were talking about Florida earlier in my parents' place with my dad, and the cost of lumber was just extortionate for a little while.
It was crazy. I had some work done on our dock, and the guy charged me $40 for some 2x4s that he needed to get up into the ceiling. And I was like, okay, whatever.
Yeah, that's how it goes. On real estate specifically, where do you get your real estate data from? Do you use ETFs to track? What would you say that would be the best sort of market data to keep an eye on for?
I don't really follow real estate data that closely, and thankfully I've got we've got some production people at our company who kind of handle all that. So we just say, hey, give us the real estate data or whatever.
Gotcha.
But I remember what helped us in 2006 when real estate was having that crazy boom and was getting ready to top out. I think it was 2005 when the REIT index topped and started down. And we said, hey, the REIT index is always ahead of home prices. This is an early hint, that home prices are topping out. They topped out in 2006 and then started crashing in 2007, 2008 and didn't recover until 2011, I think was the bottom.
Gotcha. Do you ever look at or consider home builders? It's new homes is sort of a separate market in a way.
That would be, yeah, it's fine with me. It's a sector. I don't follow sectors really. I'm mostly a broad market person.
Gotcha.
It makes sense.
Yeah.
Yeah, that would be, if I'm wondering where real estate prices were going, I definitely want to watch that.
I found it interesting just because we were talking about the states in Florida, and when I speak to my parents and people around there, the real estate prices have just boomed down there, and it seems like they came off the boil a little bit with the rise in rates, but that they've not really, if that makes sense. One would think, oh, the rise in rates or the drastic rise in rates would cause that market to slow down, which has already seemed quite sort of overextended. Yet
that's the problem. That's the problem with using economic thinking in financial markets. Stuff that should happen just doesn't. One of the most famous times that illustrates this idea was late 2012. Gold had topped in 2011, but was holding at a very high level. And near the end of the year, Ben Bernanke, the Fed chairman at the time, came out and he said, we are going to start printing money. He said, we're going to be buying $40 billion worth of government bonds every month, and we don't know when we're going to stop. We're leaving it open-ended. And gold bugs were saying, oh, this is a chance. Gold's going to go to the moon. It's going to go to $10,000 an ounce. A month later, he came out and said, now we're going to be buying $50 billion or $40 billion, whatever it was, of mortgages every month on top of the government bonds that we're going to buy. And you know what our headline was? Fed announcement, last chance to sell gold. Because we know that these things are not causal. What causes the bull and bear markets in gold is Elliott waves, and we ended the bull market already, and we had wave one down and wave two up, very similar to what we saw in the stock market this summer. And we said, people are going to be holding on because of this news, but don't get sucked into it. And sure enough, the Fed printed money. It was called QE, the brand new invention, quantitative easing. For just means, we're cranking the printing press, same old thing. And throughout the time that the Fed was printing money, gold went lower and lower and lower and then they stopped printing money and gold continued to go lower until I think it was December 2015 when it hit about 1,050. So don't ever look at so-called fundamentals. They will screw you every time. These things come as a result of what's going on in people's heads. They don't change what's going on in people's heads, at least in the financial markets.
Gotcha. Yeah, Eddie doesn't like us using the F word, the fundamentals world too much in this forum.
Or the Fed.
Yeah, that too, right? Okay, we'll let you go shortly. I wanted to address another question that came through. It's about emerging markets. And the question goes along the lines of emerging markets are making new highs. How does that fit in with US bear markets?
I don't know. I'd have to look at the wave patterns in those markets.
Gotcha.
But, it's possible that if you recall back in, say, 1966, Feb 66, the Dow Jones Industrial Average topped out what we call cycle wave 3. And then it went down and stocks had a big rally, and some stocks, including the OTC indexes back at the time, and the value line indexes went to new all-time highs in December 1968, and the Dow fell short. It was still in a bear market that lasted from 1966 to 74, in which there were a couple new highs. So you can't rule out new highs, especially in isolated or narrow markets during bear periods. They do happen on occasion. So I'd have to analyze that separately. But if any of these emerging markets are in Asia, we have a brilliant analyst who follows all the Asian markets, Mark Galashevsky here at Elliott Wave International. And if you want to look at Europe, we covered that as well. Brian Whitmer is doing an amazing job with Europe. So I just do my thing every month in the Elliott Wave Theorist, and there are a lot of things I'm not personally looking at, but we have people at Elliott Wave International that are analyzing markets around the clock and around the world.
Fantastic. I'm going to give you one more if you'll stick with me for a sec. And just a clarification, it looks like Dan, who was asking that question on emerging markets, was talking about Romania, which is up about 30% on the year, as he says. Any special views on behavior of agri-commodities?
Of what?
Agri, like so agricultural commodities, agri-commodities. So probably
No.
methods, I guess, yeah.
I mean, yeah, we've got a guy who's really good who covers commodities for us. If I said anything at all, it would just be off the top of my head. I'd really want to get a close look at the charts before I said anything untoward. So I think the best choice here is keep quiet. And if you're interested in what Elliott waves are going on in commodities, definitely, come check out our commodity pro service.
Awesome. This will be the last one, I promise. As far as this is a question really with regards to Elliott Wave and how people are using it. So have market makers, algos, become smarter with using Elliott Wave theory, do you think, making it harder to trade Elliott waves, or do you just see everything as you've always seen it unfolding?
That's a thing. Yeah, people have often said, the mechanics of the market are going to change everything. Like program trading was supposed to have done that. And a lot of people felt in 1987 that it caused the crash. So I used to give talks and I'd put up a chart of the crash and I'd say, how many people think program trading had a lot to do with this collapse? And a lot of hands would go up and I'd say, well, I can tell you absolutely it had nothing to do with it, because this is a chart of the 1929 crash, And so markets crash and they go up and they do everything. Regardless of, I think, of these mechanical things. But I'd also like to say that what people tend to do, especially the quants, is that they program into the decision-making software exactly what they would do in real time. They say, if it goes down this far or breaks these levels or, breaks some volatility band or whatever you want, then it's going to turn our system bearish. And that's just what they would do as human beings. So I think they're really programming in all their own foibles anyway. But as an antidote to that, my son Elliott is just finishing the final touches on a program he's been working on for 8 years now, and we're finally finishing up. It's called E-Waves. It's an Elliott Wave analytical system. It's different from all the others because there is not a quant element in it. Absolute time and absolute price have no place in Elliott waves, and it's nowhere in this program. It's a pattern recognition, and all the values are relative. So you can end up with a pattern recognition rather than, it's last time the market had 7 up days was, all that's irrelevant because it depends on what degree of trend you're in. So I think we're going to have something that we call qualitative analysis to set it apart from quantitative analysis. And closer we get, the more we're going to learn. We're going to tell people about it.
Sounds super interesting. Well, we've run over a little bit here, Bob. I want to thank you so much for coming and speaking with us here today, and thank you for your time. If you would, like to know more, please check out the resources that Bob's put up here for us today. That special link for the STA members. I think it was just a /STA on the end there. That's appreciated. I've also dropped into chat the link to the YouTube of your IFTA 2014 presentation if people are interested in learning a little bit more about what you've worked on and what you've talked about before. For people who might be interested in the STA, Katie was good enough to drop in a link to a little brochure on the STA. So if you're looking for a little bit more info, right at the top of the chat, you'll find that link down there. There's a lot of nice thank yous coming through in the chat. I can see here on my right. For all of you STA members, next month, just as a heads up, is the AGM. It's an in-person event this time, so at the usual location at 1 Moorgate Place. And it's also the Christmas party. So please come along, enjoy some drinks and some networking, and we may even be able to get a special guest along there as well. So once again, Bob, thank you so much for your presentation tonight. I thoroughly enjoyed it, and I think it looks like everybody else has as well. Have a fantastic rest of your day, and happy Thanksgiving coming up here shortly.
Thanks very much, and a special thanks to all my friends across the pond. Maybe we'll get together in person a little bit.
We would love to see you in 2016 if we can tempt you over in any way. Fantastic.
Sounds good.
Thanks, everybody. See you next time.